Welcome everyone to today's lecture in the Introduction to Banking. Last week we stopped right in the middle of the discussion of investment banking. I told you that it is not as easy as with commercial banking when it comes to defining what is investment banking. Usually it's defined as all the bank's activities that are related to capital markets. And as a result, it usually comprises everything that is catered to institutional investors, like pension funds, large insurance companies, other banks. You can broadly differentiate between the buy-side and the sell-side activities of an investment bank. We saw that, for example, when it comes to the sell side, the investment bank tries to sell assets, it tries to sell securities, it also tries to sell financially engineered products. I described and explained to you what financially engineered products are. Usually just the combination, any combination of linear assets as well as financial derivatives that are used to make any desired cash flow stream. And usually institutional investors request this from an investment bank. We also have underwriting, marketing during an IPO. So investment banks will advise customers, other firms, as part of their initial public offering, also as part of their seasoned equity offering. Does everyone know what a seasoned equity offering is, an SEO? A seasoned equity offering? It's basically any IPO that is not initial, that takes place after the IPO. So every time you increase capital, you increase equity, it's called a seasoned equity offering. In German, Kapitalerhöhung. Wenn Sie Ihr Kapital erhöhen und bereits an der Börse sind, dann nennt man das im Fachjargon seasoned equity offering. We also have research, and if you ever hear for example, any news that investment analysts of Goldman Sachs have now downgraded any company or say that they expect this or that sector to perform well or to perform quite badly. This is the research side of investment banking. And on the buy side, we advise companies regarding future investments. We securitize and sell products, securities, to our customers, which again are insurers, asset managers, other banks, etc. I found this very interesting, very neat graph that shows where you can make this distinction between the sell side and the buy side. The sell side is the private side, where investment banks will only cater privately to selected institutional investors. So you're an agent of capital, you're trying to sell capital from other customers, from other securities, to the client. With companies here, those are our clients, they are in need of capital. And on the buy side, we have institutional investors who want to spend money and who have too much capital and who want to buy securities. So this is where we have the investment bank here. We also have on the buy side, we have our sales and trading department. And this is where we interact with institutional investors. And here we are acting as an intermediary between those two sides. And this can also be, for example, sometimes be done by one investment bank and sometimes by a syndicate where investment banks will team up and do this together. We distinguish between the front office, the middle office, and the back office. It only refers to the proximity of the bank to the client. So the front office will be the bank managers, the bank analysts who interact with customers, with clients. Middle office is what? What is included in the middle office? Risk management, treasury. So anything that goes and that happens in the bank, but which has a close relation to the actual business. And in the back office, we have everything else that basically the client will never see. Clearing, administration, and these sort of things. So in the front office, we have investment bankers who are trying to acquire new clients, acquire potential M&A clients, for example, who do the offer and the structuring of financial products, who try to sell and trade securities, who are on the trading floor of the bank, and those traders who engage in proprietary trading. What is proprietary trading? On the slide it says trading on the bank's own account. What does it mean? You're not executing trades for a client, but you're doing it on your own, and you're doing it for your own benefit, of the benefit of the bank. In German, we have a similar word for this, Eigenhandel. So if you do proprietary trading, you're facing the risk on your own, and you might also make a high profit. Whereas in sales and trading, you're executing trades for your clients and your customers, and you're not taking up too much risk, and you're earning a small fee and a small commission. And we have research in the front office. In the middle office, we have risk management and corporate treasury. Treasury is the department in charge of keeping track of a company's liquidity and making sure that you have enough liquidity, but also at the same time managing its excess liquidity, so making sure that the company doesn't sit on too much liquidity and that it's invested short term, and we're making some money of this. That's the middle office. Back office is IT, technical control, clearing of transactions, and general administration. And as you can imagine, this is the fancy job, and this is the job where you will earn most money. This is okay, and this is usually quite boring. And if you're dreaming of a fancy life of an investment banker in the London city, then you're probably thinking of the front office and not of the back office. Okay. All three are important, of course, but yeah. Chinese walls within investment banks. Where do you think would the introduction of a Chinese wall make sense within an investment bank? First of all, what is a Chinese wall in this context? Any idea? A Chinese wall is obviously a metaphorical one that is the idea, yes? It's the separation not just between the commercial, we can include at least one between commercial banking and investment banking, but you should also install a Chinese wall between which segments and between which branches. Rather divisions. Branches are Filialen in German, that's rather divisions, business divisions. You should sometimes, yes, can lead to insider trading. You should include and you should install a Chinese wall between the buy side and the sell side. The simplest example for misconduct is if you have investment analysts, research analysts, who are supposed to do an objective analysis of investment opportunities, and for a small fee, these investment analysts will tell clients what stocks, for example, to buy and which stocks not to buy. And if these investment analysts have access to confidential data from the sell side, from an IPO, from any other division within investment banking, and they're using this to adapt their investment forecast, this is serious misconduct. So at least you should do it between commercial banking and investment banking, and definitely between the research division and the rest of investment banking. And you can come up with even more extreme scenarios. For example, the commercial bank has given a large loan to a client. The research division knows this, it analyzes this and includes some fraudulent forecast in its report to make sure that the client doesn't default on this loan. And this is why in many parts in investment bank you will have Chinese walls where people are not, where employees of the same company are not allowed to talk with other colleagues on certain matters. And this is always problematic. I told you that, for example, on most trading floors in the world, for example, here in Germany, all conversations and all phone calls are recorded by BaFin. You cannot. So if you might know that last semester, one of my friends who works for Deutsche Bank investment banking, he gave a guest lecture investment banking here at the master's level last semester. And for example, he's not allowed to talk over the phone during trading hours. And all phone calls are recorded and all conversations are recorded for BaFin to check later on if they see any indication for market manipulation, they can access the recordings from the bank, from the trading floor. So this is a Chinese wall and some regulation concerning investment banking. World's biggest investment banks. I wanted to include those because I told you, I think 1 or 2 weeks ago, that back when I was a student, I didn't really know anything about investment banks, and some of those investment banks were recruiting at my university, and I probably made a fool out of myself because I wasn't aware of what type of business these companies were in. The largest, the biggest investment banks in the world, well, actually, those are the large US bank holding companies. As a result of the repeal of the most important sections of the Glass-Steagall Act during the 90s, I told you that commercial banks in the US were allowed to buy investment banks, to merge with investment banks, to do investment banking on their own. And as a result of this, most commercial banks immediately went on a shopping spree and bought investment banks. This is why Bank of America Merrill Lynch, Bank of America, Barclays, large UK bank, Citigroup. Citi has a huge investment banking division. Credit Suisse, Deutsche Bank. Actually, there was a time in the 90s when investment banking became more important even for European banks, and European banks went also on a shopping tour, and they, I guess, each bought one smaller investment bank to incorporate an already existing investment bank into its bank holding. For Deutsche Bank, at that time was Deutsche Bank Morgan Grenfell. For Dresdner Bank, it was Dresdner Kleinwort Wasserstein, or Kleinwort Wasserstein. So each bank bought an investment bank and subsequently merged with that one, with the investment bank. So nowadays it's just Deutsche Bank Capital Markets. Goldman Sachs, world's largest investment bank, JP Morgan, Morgan Stanley, Wells Fargo Securities, and UBS. Those are some figures from 2014, JP Morgan, Bank of America, Merrill Lynch. Commission income. So this is commission income. A little bit background here. The easiest, but also probably a very coarse way to see whether a bank is big in investment banking or not is to look at its non-interest income. Interest income, the income you have as a bank from anything that bears interest, is probably related to your commercial banking. So non-interest income, commissions and fees, usually come from your investment banking business. This seems very coarse, also sehr grob, fast schon grobschlächtig. This seems very coarse. However, I can only advise you to look at a working paper, research paper that is now, I think, even 7 or 8 years old, should be published in some time, I guess, by Markus Brunnermeier, Darius Palia, and Dong. So it's Brunnermeier, Dong, Palia. Markus Brunnermeier is one of the world's leading financial economists from Princeton University. And what they did right after the financial crisis, they looked at measures of systemic risk and how bad some banks were during the financial crisis. And they tried to explain the contribution to systemic risk during the financial crisis by looking at the ratio of non-interest to income, non-interest income to interest income. So if you have a very high non-interest to interest income ratio, it means that you are big in investment banking. If you only derive your income from interest-bearing securities and interest-bearing business, it means you're a commercial bank. So in essence, the paper looks at how bad was investment banking during the financial crisis. So this here is commission income, which basically is non-interest income. And as you can see, for example, in 2014, JP Morgan had an income of almost $7 billion US. So if it's done by most of these companies, it is highly profitable and it's a big business. Now, as you can see, Deutsche Bank has 5 years ago still had 4 billion commission income at that time. You still have to subtract the cost. But now you should know that nowadays some of these banks are highly profitable, while some, like Deutsche Bank, are not. Okay, so these are the 10 largest investment banks. I think Goldman Sachs is now on top again. We also have what we call boutique investment banks. What are boutique investment banks? Just like boutique consulting companies, this phrase is used in many contexts. A boutique investment bank is usually a small investment bank that specializes on a certain industry sector or on a type of business. So, for example, some investment banks concentrate on, say, the automotive industry, and some investment banks only concentrate on M&A business. And because they do not offer the full range of investment banking services, we call them boutique investment banks. Some well-known examples: Lazard, Greenhill, Evercore, Catalyst, and those are actually called the elite boutiques, because they within this group of small investment banks, they're actually the most well-known ones. Okay. What you do in investment banking? I have to say that when I prepared my class on investment banking at the master's level, I had a very difficult time to find a good textbook on investment banking. There is none. I don't think so. You do find a lot of textbooks, English ones, of course, on investment banking, but they are all usually written by practitioners who, for some reason, don't have any clue of how to write a textbook with a proper outline, and they have no stream of thought in it. So they just put some random topics in the textbook, and it's usually just about M&A, 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 M&A. You can get some idea of what you do in investment banking when you look at these textbooks and when you look at the books that prepare you to take a job interview at an investment bank. Now, you might know that, for example, in consulting, you usually have to do case studies. Does everyone know what a case study is, and is everyone clear how you prepare for an interview at, say, McKinsey? Anyone not know? Okay. For example, if you apply, let's say, at McKinsey or Boston Consulting Group, you will be invited to a case study, to an interview. In many cases, you have like 3-4 interviews with different people, and you will be given a short case study. For example, I was once given the case study, was like 12 years ago, or 15 years ago actually, introduction of postal service, when we had the breakup of the monopoly of Deutsche Post. new market participants entered the market, and this company, they consulted and advised a company that was thinking about entering the market for mail delivery. And I had to come up with a cost plan. What is the biggest cost driver at that time? I was asked that question. If you think about delivering mail 15 years ago, what was the largest cost factor? I thought personnel. They said no, the sorting machines. I said okay, didn't get the internship. So you'll have to, and then you will be given some numbers, you have to make some calculations, and in the end they will tell you, okay, you got the internship, you got the job or not. That's a case study with consulting firms, and usually the case studies will be special to that company. For example, I once interviewed for an internship with a small consulting firm in Munich made up of ex-McKinsey consultants. And they are in the business in the telecommunications market. And back at that time, the chief editor of Focus had, I think, his 60th or 70th birthday. And in the interview, they said, okay, last month we gave to this chief editor of Focus as a gift 10 business ideas. How to make money and even more money and new ideas for Focus. Same job for you. Think of 10 ideas you would give as a gift to the chief editor of Focus. Start. Okay. So that's a case study. In investment banking, what you have to do is usually an M&A, in many cases, an M&A valuation, because this is a huge business. And you can see many things when it comes to M&A evaluation. You want to merge or you want to buy a company, and you get two problems that are always present in investment banking. First of all, you have to do company valuation. You need to value and you need to price the stake, the share in this company you want to buy. First problem. The second problem is that you usually, because you are investing a lot of money, you need to come up with a financing plan. This investment needs to be financed, and you probably have a capital structure as a start, but you have to change the capital structure in order to finance the deal. So you have to do the company valuation and then make some adaptations to the capital structure, and then calculate whether the deal is still profitable under the new capital structure. And again, most of the textbooks you will find on investment banking are rather practitioners' books that try to prepare you for these interviews, because these are the calculations you need to do in such a job interview for an analyst position in investment banking. So balance sheet analysis, valuation is one huge part in investment banking. You need to know what is a company, what is a deal worth. You need to look at balance sheet data, at income statement data. For example, like this is the one from Ryanair back in 2007. You need to standardize the balance sheet. You need to come up with financial ratios. There are many things you need to do. First of all, you need to make sure that it's in the right currency. Otherwise, you have to make a currency switch to, say, US dollars. You have to come up with financial ratios, and then you have to compare financial ratios to do the valuation. Now, this, for example, is the balance sheet of Ryanair. Not very surprising. This is the income statement for Ryanair. As you can see, 12 years ago, they had a profit of 455 million euros. This is the consolidated cash flow statement, just regular annual report for a regular company, and goes on. And this is the starting point for any company valuation. You take the balance sheet, you take the income statement, you calculate financial ratios, you have a look at the current capital structure, And what you do next is you calculate financial ratios that tell you something about the profitability of this company. And then in many instances in corporate valuation, what you do is you have to compare this to a peer group of comparable companies. In this case, this is rather difficult because there are not too many other companies that are comparable to Ryanair. But in many industry sectors, you do have some competitors for which you have additional data. And you compare these ratios for Ryanair, for example, to an average of peer group competitors. And when it comes to comparing those figures, first of all, I told you that you need to make sure that it's in the same currency. Second, you need to make sure that any differences in the accounting systems are accounted for. Most important difference, at least when it comes to banking, is that under IFRS you are not allowed to net derivative positions. You have to include all positions, even those that are hedged, and hedge accounting is quite important in this case. Best example for this is Deutsche Bank at one point had total assets under US GAAP of approximately $1 trillion. Under IFRS in the European Union, it was 2 trillion. So a reduction of almost 50% between IFRS and US GAAP, just as a result that under the fact that under US GAAP, you are allowed to net hedging instruments and positions that are meant to be hedged. Is it clear what is meant with respect to hedge accounting? Who does not understand this? Everyone clear? Okay. For example, if you buy a stock, you include it in your balance sheet. If you buy an option, a put option on that stock, your overall position and your risk exposure is zero because you've completely hedged your risk. And in case you have an open position that is hedged with a financial derivative, under certain rules, for example, in US GAAP, in hedge accounting under US GAAP, you are allowed to net this position. So you only have to include this amount on your position that is not hedged. And if it's a full hedge, there will be nothing on your balance sheet. Under IFRS, you have to include both. So it will increase your total assets. And this effect is actually so strong that under IFRS, Deutsche Bank had 2 trillion, whereas under US GAAP, it only had 1 trillion. It's quite important because when you think of, for example, say, financial stability and measuring systemic risk, just looking at total assets is actually a very poor way of measuring financial stability and systemic risk, because total assets and bank size measured by total assets is heavily influenced by accounting standards. Okay. Then different accounting between different business sectors, different company sizes, and so on. It also is difficult to compare annual report data across time. Financial ratios will change. You have different times in the business cycle you might be looking at, and different currencies and so on. So one solution is to calculate percentage quantities financial ratios. Here you can see all those balance sheet items expressed as ratios with respect to total assets. And one thing that is striking is that, for example, for Ryanair had an equity ratio of 44%, which is high, but it's extremely high, especially when compared to the equity ratios of banks. Usually banks have like 4 or 5% equity ratio. Okay. And then you can see that it had 25% in cash and cash equivalent and only 1% in derivative financial instruments on its asset side, which is okay, but it would look completely different when you were looking, if you were to look at the balance sheet of a bank. Again, the same thing for the income statement. Now all those ratios are expressed as percentages of the total operating revenues. So they had total operating expenses, 76% of operating income, operating revenues, and then in the end we had a profit of 21.41%. It's easier to compare. It's independent of the currency, and we can now compare those key figures, ratios over time, across business, across competitors, and compare it with a peer group. Then, which type of financial ratios could we look at? Short-term solvency or liquidity, long-term solvency or leverage ratios, asset management, turnover ratios, profitability ratios, market value ratios. Those are the most important ones. And you should probably know most of those. Short-term solvency, aka liquidity ratios. First one is the current ratio. It's just current assets divided by current liabilities. In many cases, it's cash and cash equivalent, but some companies might also have other current assets like security holdings that can easily be liquidated. Then we have current assets over current liabilities, which in this case is 2.11 for Ryanair, meaning that they are liquid, or they were at that point in time. Creditors, the higher the current ratio, the better. If the company has more liquidity, they are more likely to pay back its liabilities and not to default. For companies itself, it means the higher the current ratio is, the more inefficient the company is at using excess liquidity. So a high current ratio, it is actually not desirable for the company, because we are just sitting on a pile of liquidity and we are not putting it to any good use. So a current ratio of at least 1 is necessary, but it shouldn't be much higher than that. Total debt, long-term solvency. Total assets minus total equity over total assets. Now, first thing you need to remember is make sure that with banks you understand the fine distinction between debt and liabilities. Debt and liabilities, Verbindlichkeiten und Schulden und Ähnliches. Why do we need to make this distinction? Well, we do have liabilities to our creditors. For example, we have taken some bank loans. So Ryanair probably has some bank loans as liabilities, but you also have reserves, you have depreciations and so on, and deferred taxes, which are not liabilities. So first of all, make sure you understand the difference between debt and liabilities. And second, this is one way of coming up with a total debt ratio, or equivalently the debt to equity ratio. The leverage ratio, which is also similar, it is okay if it's just a coarse approximation to take this total debt ratio or debt to equity ratio to measure leverage. However, in research and academia, there's a huge discussion on how to measure market-based and the market-valued leverage. Because all those figures here are book values. They're taken from the balance sheet. But as you can see, you have to take total assets minus total equity. And you can also take, for example, some proxy for the company value, and you can take market capitalization instead of book equity. And there are some papers that discuss which and how you should measure leverage in a consistent and appropriate way. But this is an academic discussion, and you can find it, for example, in some research papers. I know one of the papers by Viral Acharya from New York University has this discussion in it. And I think he uses market capitalization instead of total equity. So total debt equity, total debt ratio, debt equity ratio, it only tells you how much liabilities, how much debt do you have in comparison to total equity. And if you turn it around, you get the so-called equity multiplier, total assets divided by total equity. And you can see Ryanair used 56% debt. So for every euro in assets, it used 56% in debt, which is not too much, again, when compared to, say, banks. Profitability measures. Very simple. Profit margin, net income over revenue. High profit margin is, of course, desirable. Corresponds to low cost to sales. It depends on how large your margins are. We'll see in a bit that you actually have some levers on how to increase your profitability. You can use financial leverage, you can use income to sales, and here we can also use return on assets, net income over total assets. You can also use return on investment, return on equity, gives you different ratios for profitability. In research, actually, we almost always use return on equity and return on assets. So this is the total return to all stakeholders, to debt holders and equity holders. So usually we rely on return on assets. Return on equity measures shareholders' profit, net income over total equity. In the case of Ryanair, 18%, quite nice. Okay. Again, those are accounting returns. So to be precise, you should rather call them return on book equity and return on book assets. You can, of course, use market capitalization and a market figure for total equity. Then you would get return on market valued equity. This here, this is important. This is the so-called DuPont method of describing the return on equity. Net income over revenue times over assets times assets over total equity gives you the return on equity, but also it means that the return on equity is given by the product of profit margin times total asset turnover times the equity multiplier. And you can easily see 3 ways and 3 levers how to increase your return to shareholders. First of all is you have to increase the income you can generate from €1 in revenues. Better margin. You can increase the revenue for each euro in assets. That is, increase your revenues and make a more efficient use of your assets. And the second one is the equity multiplier. That is simply financial leverage. Very simple way to see that you can actually increase your return on equity by doing nothing but adjusting your capital structure. This is just financial leverage, and this is just a question of capital structure. Per se, it has nothing to do with your actual business. And this is the DuPont decomposition of the return on equity. Okay. In this case here, 21% times 0.36 times financial leverage, and we have operating efficiency, asset use efficiency, and financial leverage as the 3 levers to control the return on equity. Okay. You don't need this. Market value measures. Price earnings ratio. You can take the share price for a listed company and divide it by the per share earnings of the corporation, and you get the price earnings ratio. It measures how much investors are willing to pay for 1 unit of current income, for €1, for example. So high PE ratios are usually seen as an indicator of significant growth opportunities. So you are actually seeing that companies with a high price earnings ratios, those are the growth stocks. Those are the corporations for which you expect the stock price to increase in the future, and vice versa. And in this case here, 12 years ago, the price earnings ratio for Ryanair was actually 16, and quite high price earnings ratio. And last but not least, market to book ratio. If you take the per share market value and divide it by the per share book value, or total divided by total market by total book value, you get the market to book ratio. And it's an accounting number that reflects historical costs, and in the denominator you have the market value of the corporation, and it gives you what? This ratio shows you if a corporation is undervalued or overvalued. If it's undervalued or overvalued. In this case here, the market to book, it's not NUC, but book ratio, was 2.75. A value less than 1 could mean that the company was not successful in creating shareholder value, because book assets are 1 billion, or book equity is 1 billion, and market capitalization, market value is $500 million, then it has actually destroyed value. So this is how you can use the book to market ratio. What would you do next? Now, valuation, as I told you, is one important part of investment bank. Could be that this is just your job, to do a corporate valuation, to come up with a price, with a fair price for a company someone wants to buy. Could be that this is used as part of an M&A deal, could be used as part of your IPO investment engagement, that you need to value this corporation and to come up with a fair share price. And it can also be used in leveraged buyouts, and this is why you need valuation in almost all segments of investment banking. Now, what are leveraged buyouts? Again, this can be combined with the corporate valuation, because in many cases, the investment bank not only does the valuation, but it also helps the company to adjust its capital structure and to get new financing and new debt financing. Now, in a leveraged buyout, this is the case when an investor or a group of investors, sometimes managers, buy a target company and they finance this purchase with a small amount of equity and a substantial amount of debt, of borrowed capital. Profits and assets of the company that are bought are used to hedge the borrowed capital and to service interest claims, and these leveraged buyouts are typical of equity investors and usually of what we would call a hedge fund. You take a target company, you use a small amount of equity, and you use a lot of debt, and you use the company's assets and its income and its current income to service the interest payments on the debt you need to finance this buyout and this deal. This is an LBO, or leveraged buyout. There are some typical types of leveraged buyouts. A management buyout, when you purchase a significant stake in the company by current management. A management buy-in, if a significant part of a company's equity is bought up by an external management team. So managers come into the firm from outside the corporation. A secondary buyout, if a leveraged buyout of a company in which both the buyer and the seller are themselves private equity investors, or financial sponsors of a leveraged buyout, and a tertiary buyout is the sale of a company through a leveraged buyout that was previously acquired as part of a secondary buyout or was initially bought in a leveraged buyout. So it's an LBO of an LBO of an LBO. Very good example for such a deal by a hedge fund is the example of Grohe. You probably know Grohe. Grohe is a huge world leader in bath appliances. So if you go to a bathroom, you will probably see an appliance by Grohe. Huge company, or large company actually, was family owned until I'd say 15, 20 years ago. Family owned, and as in many cases with family run businesses, at some point the family owners lose track They get old, the sons or daughters take over, they are not very interested in running a business, they're only interested in spending the money from the business, and they ran the company down. And it was bought up by a private equity investor. Usual story, they also cut some personnel, they cut some jobs, they used a lot of leverage, but I guess this is actually rather one of the more successful stories of a private equity investment, because they forced the old investors out, the old owners out, they changed the old management, and they consolidated and restructured the company. And actually Grohe, I think right now, check it up on Wikipedia, I think at the time it is now in its tertiary buyout or even its fourth LBO, and at some point it was owned by a Japanese private equity investor. This is actually a very good example, because if I'm not very much mistaken, this was the main cause for this infamous discussion we had in Germany, this public discussion of private equity investors and hedge funds acting as grasshoppers. Das war der Auslöser, der Grohe-Deal war der Auslöser für die Heuschreckendiskussion, die Heuschreckendebatte. Ganz berühmt, das war nämlich einer der ersten öffentlichen Deals, wo ein Private Equity Investor eine alte deutsche Traditionsfirma übernommen hat. Und ich meine, es geht auf Müntefering zurück, der dann die Investition von Heuschrecken von den Finanzmärkten dann angeprangert haben. Grohe ist tatsächlich eines der besseren Beispiele. Also die gibt es noch, die sind nicht zerschlagen worden, die sind immer noch vermutlich sogar in manchen Bereichen Weltmarktführer, und die waren eben auch einfach zugrunde gewirtschaftet von den Alteigentümern und den ehemaligen Eigentümern. Does anyone know a good example for a management buyout? There are some actually, there's one business sector where you see a lot of management buyouts. In consulting, I might have told you that consulting firms are prone to suffer from principal agent problems, because you have employees, you have usually, as a consulting firm, you have no physical assets, and the only assets you have is in human capital. And human capital can walk out at an instance. And if you don't keep your employees satisfied, usually with a high salary, and if you don't align the incentives of your employees, of your consultants, with your incentives as a company owner, as a shareholder, you will get problems. And you cannot run a consulting firm like you can, for example, a tech company or a shoe company. You need to motivate your employees, because otherwise they will just leave McKinsey and they will hire and team up with Boston Consulting Group, or they will go and form their own company. This is how all the consulting firms, by the way, were founded. Each and every time, for example, 100 years ago, people at McKinsey or at Boston Consulting Group said, oh, this company sucks, I form my own company. So they walk out, they form a new company. Actually, the same thing in many universities as well. Cambridge University was formed by frustrated scholars from Oxford University, and so on. And there are some famous examples where consulting firms were actually sold to investors. And this has never really worked. You need to make your top employees, your partners, you need to make them equity partners, shareholders, because otherwise your top employees will just walk out and take all the clients and customers with them. Does anyone know a famous German consulting company that actually was sold? I think it was sold to Deutsche Bank, didn't work, and then management, the top partners, bought the company back as part of a management buyout. Roland Berger, the only strategy consultant company that was founded in Germany, actually, Roland Berger Strategy Consultants, I think in the 90s was sold to Deutsche Bank. Didn't work as expected, and then management, top partners, bought it back from Deutsche Bank. So this is where you have management buyouts. What you need to do is identify potential target companies, value the target company, support the transaction, advise how to structure the financing. You need to place the bond, and it might be that you're also in charge of that, or that you need a syndicate of investment banks, and one of the investment banks is in charge of bond placement, finance the debt, and advise and support the managers and shareholders of the company, of the private equity investors, on how to do the exit. Usually after 5 years, the private equity investors want out. How do you do an exit in these sort of deals? Either by doing a secondary LBO, someone else, another private equity investor buys you up or buys you out, or you do what? IPO. You take the company to the stock market and sell it as part of an IPO. There is one, I forgot it. There's one company that is about to do its IPO or has already done its IPO. And actually one large shareholder is a private equity investor that is earning a lot of money on that. I think it's the TeamViewer IPO? Is it TeamViewer, or is it, with, for example, Uber, Twitter, and these tech startups, in many cases, those tech companies were also supported by private equity investors who, when they did their IPO, they cashed out. That's how they plan this exit. What you do in an example LBO model, and this is actually taken from one of those books in which you are prepared to take an interview with an investment bank. You will be given some data, maybe an Excel sheet, and you need to make some estimates regarding the purchase price. You have to create a sources and uses list for capital. That is, you need to calculate the capital requirements. Don't mistake this for capital requirements of a bank. It should rather say capital needs. What do you need? What capital do you need to finance the deal? And where is the capital coming from? Does it come from a private equity investor? Is it in bank loans? Is it in a bond that needs to be placed? You need to forecast the financial statements. For example, let's make this example with Grohe. For example, you would be given the financial statement and some data on Grohe. So you would see that in order to buy the company, you need, say, 2 billion euros. Capital need is 2 billion. You need to calculate the uses and sources list. So you need 2 billion, and what are the sources? You will need a small amount of equity. You will need a lot of bank loans and debt and bonds maybe. You need to finance those. You need to place the bonds. Then you would forecast the financial statements of Grohe under the new capital structure, because the capital structure will be adjusted and it will be tilted towards a higher leverage. It's a leveraged buyout. And you would probably do this for 5 years, because in many cases, on average, after 5 years, you plan your exit. You will forecast those financial statements and then adapt the balance sheet to the new capital structure and see what could be achieved by selling the capital, the company, after 5 years under not too pessimistic estimate for the balance sheet. And then you can see what is the company worth under these assumptions after 5 years, what can be paid in order to buy the equity of this company, and should you go forward with the deal. And this is what private equity investors would ask of the investment bank in such a scenario. Do a valuation and make the structured financing and evaluate whether this is a profitable deal or not. So what does the success of an LBO influence? Strong, effective management, After the LBO, the management must work together with the new owners in order to leverage the company's earnings potential under the new capital structure, which in many cases means you fire old managers. You fire the old management team and you bring in new managers. Low debt ratio, because you are financing this deal with a lot of debt. You are only looking for companies that have, at this point, a low debt to equity ratio. Because if the company is already operating at a high leverage, with high leverage, there isn't too much room to increase leverage. So what you're looking for is usually a target company, a takeover target with bad management, old shareholders who want to sell, low debt to equity ratio, but a high potential. And now let's take this example of Grohe. If you walk into a bathroom in Japan, in Dubai, in the US, and in every second or third bathroom you see an appliance by Grohe, you know that this is a market leader, and actually this is a company with a strong brand, and there has to be some explanation why this company is underperforming. And when you see, okay, this is an established brand, very stable business, you always need home appliances, and you always need a bathtub, for example, and you see that old shareholders and old management have run this company down, this is the perfect takeover target. Low valuation, low debt to equity ratio, bad management, stable brand, stable business, high potential, if only it were managed properly, and you would be buying this company. Solid wealth structure, low operating risk, and stable cash flows. We just saw this. Companies with low price earnings ratio, well, it needs to be cheap. If this is a company that has bad management, but the company itself is still very, very expensive to buy, well, no private equity investor would be interested. It needs to be a company that is currently undervalued to buy it. And in many cases, it can also be that those are conglomerates or holdings where you see that some parts just do not fit into this portfolio of the company. And then you can split it up. You can sell off some parts which are better run by someone else or better run independently. And the sum of all the individual parts is actually larger than the whole. Why is that? There are some good and bad examples for this. For example, I would say the takeover and the saving of Karstadt was a bad example for this, because it was clear from the very start that those investors that took over, that saved Karstadt a couple of years ago, were only interested in breaking it into parts and selling off the crown jewels. Now, with some companies, it's quite evident that divesting is actually a very good thing. If you are a conglomerate and you can see that your company has just grown too big and you have too many parts that do not fit together, it is better to sell some parts off, and the company can do it itself, or it needs to be forced to do so by new private equity owners. Do you know some examples where actually companies have realized themselves that they are too large and that some parts simply do not fit to the business? Bosch, okay. What do they sell? Okay. I actually do not know which names they are now operating. It might be that they're still Bosch. Some other examples, more prominent ones in Germany. Siemens is famous for selling off some parts. For example, Infineon was part of Siemens. Osram has now been sold. Another company, Bayer. Bayer has sold off some large segments They still keep some of the shares, but only a minority interest in those former segments and former divisions. And they want to concentrate, for example, on pharmaceuticals. And then they sold off some parts. What is the name of the chemical branch of Bayer, the former chemical branch? Lanxess. Lanxess is now an independent company. It used to be the chemical branch of Bayer, which is now concentrating on pharmaceuticals. Those are examples where the company management realized themselves that it is best for shareholders to sell off some of those parts that do not belong to the core business and concentrate on its core segment. And in many cases, when managers do not realize this themselves, company value will suffer, shareholder value will suffer, and then a private equity investor will step in and they will exchange management and then do it themselves. Okay. IPOs, M&A, large part in investment banking, can be done as a private placement or public issue. What is a private placement or a private placing? You're not taking it to the stock market, but you're taking the stocks to individual institutional investors. Now, remember that under corporate law in all countries, you have to distinguish the case of a stock company and a public stock company and one that is listed. Even in Germany, you can found and form a stock corporation, but this only means that your shareholders keep their shares in the stock in the form of stocks. It doesn't mean that this company is listed on a public stock exchange. So there will be no stock price. Simply means the shares are formed in stocks. And those stocks can be placed privately. For example, if I form my own stock corporation, I can sell some of my shares, some of my stocks, to, for example, you. Then you are my private investor and you invest in the stock corporation. Now, if the company is listed, you can buy the stocks on the exchange publicly. This is a difference. And in some cases, investment banks will help investors place stocks privately. To institutional investors, of course. So privately is a little bit misleading. It's not to private persons, but it's privately to institutional investors. And they will also assist in public issues. Now, an IPO is a public one, initial public offering, or an unseasoned new issue. Any subsequent one is called a seasoned equity offering or a rights issue. German natürlich Börsengang bzw. Kapitalerhöhung. It's a seasoned offering. And investment banks advise and help clients they can do this at every stage of the IPO process. With the Pathfinder prospectus, with the pre-underwriting conferences, when the complete prospectus is published, with the public issuance and sale, and afterwards during market stabilization. So what an investment bank will usually do is, they will first start out as a consultant. They will tell you, if you want to do your IPO, you need to do this and this and that. You need to prepare this. Your accounting department has to prepare these figures. You have to be able in marketing to come up with this prospectus and so on. Then they will help you with pre-underwriting conferences, meaning that they will organize meetings with institutional investors who could be willing to buy your stock. Then they will help you write the complete prospectus. The prospectus is a huge PDF file actually that lays out all the necessary information on this new stock. What kind of business you're in, what your balance sheet looks like, what your forecasts are, and so on. Then you have the public issuance and sale. This is also the technical part. They will help you interact with stock exchanges and so on. And then you have market stabilization. Market stabilization could mean that the investment bank actually buys up all the stock, and they will be selling it to investors for a markup, for a fee. The nice thing for the company is that if the investment bank underwrites this, it means that actually you are guaranteed a certain amount of capital that is sold. The nice thing for the investment bank is the investment bank can try to sell it at a higher market price, and the difference that the investment bank is paying you, the IPO company, the new company, and it is making on the market, this spread is the fee for the investment bank. And sometimes in market stabilization, they will also do what? They will buy up shares if the stock price goes down. A pretty good example is, for a botched IPO, is the one by Facebook. Most of you probably don't remember this, but Facebook's IPO was far from being successful. The first stock price of Facebook actually went down. Why? At that time, Facebook, well, they're still controversial, but the business outlook for Facebook was very controversial. Why? They were growing, they had a lot of business, but at that time, they were only able to bring advertising to their PC, computer-based Facebook site. There was no advertising on mobile phones. And investors were not sure how they could bring advertising to mobile phones, and if they would not have been able to do this, to accomplish this, Facebook would have probably gone bankrupt, because people were switching to mobile phones, and if you don't bring advertising to mobile phones, then there is no revenue to be made on your mobile business. So back at the time of the IPO of Facebook, Facebook wasn't such a sure bet. And actually the investment banks did their part, and the stock price of Facebook dropped immediately after the IPO. And this is always a very negative sign. It shows that actually the price was set way too high, and all those investors that have signed on to the IPO are immediately kicked in their behind, because you have bought the stocks for, say, $25, and if the first stock price goes down to 15, you've lost $10 on the very first day of your investment. That's always a dramatic, catastrophic signal. Now, what investment banks can do is they can guarantee to stabilize the market, which means that if the stock price goes down, say in the first 30 days, they will buy stocks and stabilize the market. They will stabilize the stock price for a fee, of course. That's a public issue. Now, when the takeover bit, when you want to take over a company, when it's done public, investment banks can also help and advise. For example, as part of an underwriting syndicate or as a consultant. Now, in a firm commitment agreement, the company negotiates an agreement with the bank to secure and market the new shares. So for a fixed number of shares, they are bought by the underwriter and they are sold at a higher price. That's the risk of the investment bank. It acts as an underwriter. It accepts the risk of not being able to further sell the securities. And in order to minimize the risk, investment banks will usually form a syndicate, and you will have one lead syndicate investment banks and some others that only take up smaller parts of the new shares. And this spread or discount, this is the difference between the price the syndicate banks are paying to the investment, to the company, and the price they are making on the market when selling the stocks again. The higher the spread, the higher the discount, the more profit, and the higher the profit of the investment bank will be. In the best efforts approach, the investment bank only says, well, I'm trying my best. I will try my best to sell and market the new stocks, and the investment bank will be paid a commission fee for each security that is sold. However, they are not bearing the full risk of not being able to sell the stocks. If they don't find a buyer, well, less capital will be raised and less shares will be sold. So there's no guarantee how much money will be raised. And then finally, you also have a Dutch auction. In a Dutch auction, the underwriter does not set a fixed price, but conducts an auction in which investors bid for the shares. They will say how many shares they want to buy at what price, and then at the end, the auctioneer will set a fixed price and say, well, the first 12 investors will now be allocated this number of shares at a price of $28. So this Dutch auction, this is also sometimes done. So firm commitment underwriting is more widely used for larger issues than best effort underwriting. Smaller emissions primarily use best efforts. Why? Because the investment banks are not in need, are not so desperate to do a firm commitment when it comes to smaller issues. They will just say, okay, we'll try our best and we'll get a small fee and small commission for each share sold. Many underwriting contracts contain a so-called green shoe clause or green shoe provision. Why is it called green shoe? Green shoe was the first company in which this provision was used. So this is just why it's called green shoe provision. It gives the investment bank the option to acquire further shares at the offer price. So if the offer price is, say, 25, the stock price goes to 30, and the investment bank has a green shoe option of, say, buying another 1 million shares at 25, it can exercise this option and make 5 million profits. Why is a green shoe option included? If you see that the investment bank was able to sell all stocks and investors are still interested in buying the stock, it is an opportunity to include such an option to even further increase capital. So you can meet excess demand, and for the investment company, obviously, this is a benefit. This is an option that has a positive net present value. And afterwards, might be that the investment banks are forbidden from selling shares. They might stand ready as an underwriter to stabilize the market, and that's investment banking. So they provide advice, they market securities, act as underwriters, bear the responsibility of fair pricing. They should have a self-interest in pursuing fair pricing. Why? There are not too many investment banks around. And if you botch 1 or 2 deals, clients will look for another investment bank. This will set a bad reputation for you. And if you have a bad reputation of wasting investors' money, people will go to another investment bank. And there's a tough market for M&A deals and IPO deals here between the investment banks. Now what you can do is, if you're a company and you want to do an IPO, is you can do a competitive offer or a negotiated offer. So with a competitive offer, the issuing company can offer its securities to the highest bidding underwriter. Well, actually, you have to be Facebook to do this. You have to be a large company that is coveted by many investors. If you're an unknown small company, the investment bank will not care. You can try your hands at a competitive offer, but I guess most investment banks will not do an offer. Then you will do a negotiated offer where you work with an underwriter. And companies usually do not negotiate with several underwriters at the same time and negotiate a deal suffer from lack of competition. However, the issue costs in negotiated deals are also higher than in competitive deals, but if you're small, you usually don't have any other option than do a negotiated deal. Price of the offer. Again, we come back to valuation. The investment bank has to do a valuation of the corporation, of the stock price, of the stock, to be able to complete a successful IPO. Problem is, this is even more difficult than for a company that has a listed stock price. So you have to do corporate valuation. If the offer price is too high, the stock price will go down. If the stock price is too low, the company is wasting capital. It could have raised more capital, and it hasn't. So this is a problem. And this means that the investment bank should have an incentive to come up with a fair price. However, what you see empirically in most cases is what? What would you expect? Initial stock price that is too low or too high? What would you expect? It's a stylized empirical fact that it's almost always one and not the other. We almost always observe underpricing, that the initial stock price is set too low and the stock price, the first quoted market price, goes up. Why? Some explanations for that. First explanation is that this is just a bonus for the investment bank. That the company agrees to setting it a little bit lower in order to pay in part the investment bank a fee. Second reason is basically a signaling approach. It's always better to have a stock price that is set a little bit lower so that the first quoted price goes up. Everyone wants to buy Deutsche Telekom. Rather than having the bad signal of Facebook stock goes down the drain. Companies and investment banks want to prevent this from happening. They want to prevent the case of a bad signal created by a stock price that plummets. There are many more explanations for underpricing, but usually we observe underpricing. How can you value the equity? How can you price it? Through comparables, for example. You take the book market value ratio and you take the price earnings ratio. You come up with the price earnings ratio or the book to market ratio of a peer group. You can calculate a multiplier if you can observe a stock price for those companies, and then you can multiply the multiplier with the price earnings ratio or the book to market ratio of your target company, and then come up with an estimate of the target's equity. Clear? Yeah? Valuation through comparables. Maybe you have taken Professor Diedrich's class on Unternehmensbewertung, or you're about to, and then you will learn even more about this. Valuation through comparison. Basically the same thing. Here, for example, you can see some book to market values and price earning ratios for some selected companies and the competitors. And what this table shows you is it works for some companies, but it doesn't work for some companies that are new. For example, if you look at Amazon, Amazon is a logistics company, basically. And at some point, it had a price earnings ratio of 47 compared to 22 in the peer group of its competitors. Why? Because Amazon is a singular event. It's a unique observation in an otherwise very stable, very old conservative business. So if you were to compare Google, for example, to what would you compare Google? There is no second Google. If you take McDonald's, on the other hand, simply compare it with Burger King, KFC, Pizza Hut, and so on and so on. Or you can even stay within the burger segment. You can take Dairy Queen and some other burger chains. So it's easier to compare old traditional companies with their competitors rather than comparing new companies that are still growing. So that's obvious here. You can also do discounted cash flow. You forecast the future free cash flows. You have to, actually this is also done in those model LBO calculations. You have to do some forecasts for the free cash flows. You have to, then what do you have to do next? crash course in asset pricing. How would you price a stock? How would you price a share in a company? How would you price an asset? It's the present value defined as the sum of the discounted cash flows. So what you can do for a stock is you can forecast the future cash flows, which is what? Dividend, 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 and at some point you will be selling the stock again. Actually, you can neglect the sales price, so just concentrate on those dividends. Take the dividends, forecast the dividends, and then what you need to do is you need to discount the future cash flows. This is where it gets tricky. Now, if, for example, you take this 1 plus R, what is R? From where do we get R? Is it the weighted average cost of capital? Is it the cost of equity? What is it? I don't want to get into this. This is a full semester class on asset pricing or corporate valuation. But in essence, it's just that. To price a stock, to price any asset, you have to forecast the future cash flows and to use a proper risk-adjusted, appropriate discount rate. And then you're done. So if you try to come up with an estimate for the stock price, for the fair stock price, you could also do the same. Just neglect everything you see from a peer group. Don't take the financial ratios, but simply do a forecast for the future cash flows, for the dividends, and then try to come up with an appropriate discount rate. Now this is the tricky part. Dividend forecasting is actually much easier than coming up with the appropriate discount rate. And then it might look like this: dividend 1 plus dividend 2 plus the price, and so on. And you can see if you do this over and over again, in the end, it looks like this. The sum of all those dividends plus the price at the very end if you sell the stock. And if it's a long-term investment, it's a perpetual stream of cash flows. And this here, oh no, the limit of this is 0 for h to infinity. So simply neglect this and you arrive at this. Jedem klar? Die letzte Zahlung, wenn Sie langfristig denken, wird die am Tag des jüngsten Gerichts fällig. Und wenn Sie das über unendlich viele Perioden abzinsen, ist der Barwert gleich 0. Dann können Sie es auch weglassen. Dann sehen Sie relativ einfaches Ergebnis aus dem Asset Pricing. Der faire Aktienkurs, der faire Preis ist was? Einfach die diskontierten, vorhergesagten zukünftigen Cashflows, die Dividendenzahlung. Okay. Hence, share value is equal to the discounted stream of dividends. And we need to know the expected dividends, and we need to come up with the appropriate discount rate. Those are the main difficulties here, and then we can price the stock. Same thing can be done with the free cash flows. Same formula, only different discount rate. No? That's the same. Okay. And then, last but not least, we have trading and structuring. Actually, those two slides I can do today, and then we're done with investment banking. Sales, trading, structuring is the trading floor of an investment bank. And it's virtually this, literally this. It's a trading floor where you have traders sitting on their computers, sitting next to a telephone, talking with institutional agents, institutional investors, trying to sell and buy securities, executing orders, and trying to generate a profit from trading and buying and selling stocks. It's a sales desk of an investment bank. It is more than just this trading floor. It's not just people sitting on a floor on their phones, buy, sell, but the sales desk is also where people try to come up with investment ideas and where they pitch ideas to other institutional investors in meetings. And you want to buy this, we have a good investment opportunity that looks like that. They submit offers, and if a client places an order, it will then be forwarded to the trading desk. And the trading desk is the trading floor, which executes the orders. Simply, the front office of an investment bank executes trading orders. Structuring then is taking together linear assets, financial derivatives to come up with structured finance products, and usually including a derivative component. You don't combine just stock with a stock or a bond with another equity. You usually have a derivative included, because this is where it gets risky and where you should do it wholesale in large quantities to have some risk management protection. That's trading structuring. Any questions concerning investment banking? Because this is the perfect point for me to stop, and next time we will then continue with financial accounting, something very, very different from investment banking. Thank you, and have a nice evening. I will not be here next week. I will be on a conference, but one of my research assistants will substitute for me. So, thank you very much.